All right. Good morning, everyone. Hopefully everyone can hear me. We're just going to give it another minute or so for people to join us, and then we will get started.
Buenos días, espero que me puedan escuchar. Vamos a dar un minuto o dos para esperar que se conecten las personas y luego vamos a empezar.
All right. It looks like we still have a few people trickling in, but why don't we get started so we can try and stay on schedule. Before we jump in, I'm going to turn it over to Erica Perez to discuss the Spanish translation services for today.
Ok, mientras que se sigan conectando el resto de las personas, vamos a explicarles que este evento va a ser bilingüe en inglés y en español. Así que para las personas que hablan español o si conocen a alguien que va a necesitar interpretación, está un globito en la parte de abajo de su pantalla. Hagan clic ahí y escojan español y listo. Si están utilizando su celular, hay 3 puntitos en la parte de abajo, en el lado derecho. Presionen ahí y busquen interpretación de idiomas. Va a aparecer inglés-español. Escojan español y luego asegúrense de presionar finalizado. So just in English very quickly, this will be a bilingual webinar for if you know anybody that needs Spanish interpretation. There's a little globe at the bottom of the screen. Click there and choose Spanish. And for those of you English, in case someone speaks Spanish. And if you're using your cell phone, there's 3 dots on the right bottom side. Tap there. You'll see language interpretation, choose English, and make sure to press done. And just for the speakers, please be mindful to just speak at a regular pace so I can catch up with all of you. And good luck.
Great. And thank you, Erica, and good morning again to everyone. And thank you for joining us today for part of our webinar series on growing the cooperative economy. And thank you to our sponsors today. There's a lot of work that goes in behind the scenes to put these events on. And we appreciate the support of certainly my firm, Bernstein Shur, the Cooperative Maine Business Alliance, Cooperative Development Institute, and Cooperative Fund Northeast as well. As you can see, this is a 3-part series this year, slightly shorter than what we did last year. This is the second of 3, and I invite everyone, if you didn't join the first one, it'll be available online through our firm's website, and I invite you to join the 3rd session coming up a week from today on planning and financing cooperative expansions. For today's webinar, we're going to focus on strategies for new co-ops, financing, business planning, and growth. I'm excited about the group of panelists we have. For those I don't know, my name is Adam Prescott. I'm an attorney at Bernstein Shur, law firm in Portland, Maine. I am a shareholder in our business restructuring and insolvency group, and also work with a number of co-ops around the country on a wide variety of issues, from sort of formation through corporate governance issues, all the way through dealing with financial distress, which certainly does arise. So let me stop there, and I'll turn it over to Sarah to introduce herself.
Good morning, everyone, and thanks for being here. I'm the co-founder and CEO of Tootie's Tempeh. We make delicious tempeh in Biddeford, Maine, and source our soybeans from Maine organic farmers. And I'll be sharing some of our story starting back in 2019.
Hi, and I'm Helen Coburn. I'm a shareholder here at Bernstein Shur in our business law practice group, where my practice focuses primarily on corporate and securities law issues, which means when startups need financing, I'm usually one of the people at the table helping them through that process. and that extends to startup co-ops as well. So for today, we have a pretty packed agenda, and as Adam noted, this series overall is a little shorter than what we did last year. So we're essentially trying to condense 2 different sessions into one. So you'll have to bear with us. We're going to move quickly through some sort of basic framework topics in terms of what is a cooperative, why might you want to be one, and work through some of those early stage startup issues. So part 1 will be introduction to co-ops. Part 2, just overall timelines, what if you're starting, what you need to be thinking about, and if you're going to be converting from an existing form of legal entity to a co-op. Part 3 is looking at, with a little bit deeper dive on business planning and financial modeling as you work through what you're going to need to do to finance your organization. Part 4, which we're going to try to leave the most time for, is the case study looking at Sarah's business, Tootie's Tempeh, in greater detail and walking through the framework that we will have just gone over. And then part 5 is our Q&A. We will try to leave some time for that as well. I know the last session ran a bit short. So with that, we'll dive right in to a crash course of Intro 101 to cooperative startups. And I'll hand it back to Adam for a minute.
Yeah, great. Thanks, Helen. And we know we have attendees with various different backgrounds and experience with co-ops, but we thought it would be helpful to just set the table at a very high level. When we refer to a co-op, what are we talking about? And I would encourage those who didn't attend a webinar last year or haven't watched them online to do so, because we do have sort of cover this through the course of a couple hours with a number of experts who joined us. So there's definitely much deeper dive and resources available. But for today, just at a very high level, in terms of what is a cooperative and common types of cooperatives, there's a lot of definitions about how to define a cooperative. I think that at the simplest sort of way to think about it, and how I think about it, is it's a business organization that's governed by the members, and those members are individuals who either work at or otherwise are involved in the operations of the business, right? So you have the people, sort of members running the business for their own benefit, right? And I think maybe the way to think about that is to compare it to a non-cooperative business structure, right? Where you have, you have an owner or a group of owners in a different structure, and then you have maybe your board, and then you have management, and you have employees, right? And in the cooperative structure, it's a very different structure where you actually put the users or the workers or the consumers in that governance structure as effectively that ownership class, right? And so that has a lot of implications in terms of the finances and the governance of the cooperative, and others, all the way down to like legal and tax implications, right? And so there's a lot of different types of cooperatives, and we've worked with many of them here in Maine and elsewhere. There's worker-owned cooperatives where you have the employees are the member owners, to consumer cooperatives, to producer cooperatives. There's housing cooperatives, and then you can also have sort of multi-stakeholder cooperatives where you have some combination of those, right? So a lot of different structures depending on the type of business and what the business is trying to serve. Again, we could probably have an entire hour of sort of pros and cons of forming a cooperative. I think that the sort of biggest way I think about it is in terms of engagement, and getting those members to have a more engaged stake in the business, right, than you maybe would have otherwise, right? If you're you shop at a grocery store, you may be far more engaged and invested in the business if not only are you just a customer, but you're actually a member of the co-op, right? And you have the right to vote in decision making with the co-op. Same if you're an employee, right? You're going to be more engaged in the business and the business's welfare and operations, if you're also a member and sort of have the voting power and the governance principles around that, right? I touched on a little bit about how the ownership and control compares, but what you have in the co-op structure is those member owners sit over the top as the equity group or the controlling interest, and so they have the right to vote on certainly not everything the co-op does, but on big matters for the co-op, big decisions, electing board members, things like that, right? And so again, you have giving employees or consumers or other individuals a much more direct control and vote, and much more democratically run governance structure than you may have with a corporation that maybe has a CEO directly, and maybe one or two owners, right, who are making a lot of the decisions. So a very sort of different type of governance structure. In terms of the economics of the co-ops can be for profit or not for profit, but there's a lot of sort of economic drivers and tax benefits for cooperatives, and avoiding double taxation issues and how it's structured, which again would be another hour into itself if we were going to discuss all of that. But the big economic driver for membership co-op, for membership in a co-op, is the ability to have receive patronage dividends, right, which is your share as a member of effectively the profit or the equity of the company, right? And that kind of comes all back around to what I talked about at the beginning, right? It's a very different structure where the profits of the company are flowing back out to the employees or the consumers, as opposed to up to the existing equity group, right? So just a different way to run a business from top to bottom.
Thanks, Adam. And on that last point, and we'll talk about this in a little bit in greater detail, but that can also have a bearing on the structure of financing for the entity, because if you're paying these patronage dividends to the members of the co-op, you need to make sure that the investors who may be coming in understand how that works, because it affects their economics at the end of the day as well. So moving on, so if you're starting out with a brand new idea and you're trying to decide what's next, this is this slide. We're talking about kind of the process of starting a new business and forming as a workers' co-op. So there's a number of different stages. Again, we could take much greater time going through each one. Stage one, I think of as sort of the exploration stage, and this stage is the same for any new business. So this is, maybe you haven't even formed a legal entity yet. You're thinking about a particular idea that you have. You're reaching out to friends, family, people in your network to understand, is there a demand in the market for what you want to do? And this could be whether it's starting a cooperative grocery store, starting a new tech company, something, it doesn't matter what the industry is. Everyone is going through this exploration process. Part of that exploration, oh, Sarah, you're raising your hand.
I just wanted to add that if you're not sure whether you want to be a co-op or not, it's a really good question to start with your values. And if you really want to be around for a long time, and you really want to, and your values are to benefit the community as well as your workers, I think that should inform whether, because if you're really in it to make, to sell a company and to, then that's a very different structure, I think. So I would just add the values part to that.
Yep, absolutely. And I would say a lot of times when a new company is starting and thinking about, do we need to, when I say new company, a founder or group of founders with an idea is thinking about, okay, we want to move this idea forward. Let's form a company. Classically, the decision has been, do I form as an LLC? Do I form as an S Corp or a corporation? And this is stage one, where you really want to think about that very broadly. Do you want to be an LLC? Do you want to be a corporation? You can be either of those structures and also be a cooperative or a benefit corporation. So it's really thinking holistically about what is your objective? What is the product that you're selling? What is the market you're trying to address? And how does that all fit together in terms of the type of business entity that you might want to be? At the stage one, you may actually be working potentially with legal counsel or on your own with various resources to form that entity. Or you may not actually start forming that entity until you're kind of at stage two, which is really taking some of those ideas and setting them forth with a cohesive business plan. So you've identified, again, what your market is, what your product is, and how you want to proceed, but you need to put together at least a loose framework of a plan for how that's going to happen. Which market are you going to address first? Is it a particular share of a market that's nationwide? Is it very local? And how are you going to finance that? How many employees do you need? All of these things kind of go together in your business plan, which will involve financial projections, so that you can then think about what type of financing do you need to make this idea a reality. So that brings us to stage 3, which is securing capital. And capital can take many different forms. It could be in the form of loans, grants, or through the process of offering and selling securities, which that can include, the most easily understood is, stock on a publicly traded exchange. That's not what's happening here, but when you think of a security, that's what you're getting, a share in a corporation. It can also include, though, certain types of debt instruments and things like that. So there's a big array of types of financing mechanisms, whether you're a co-op, a tech startup, or someone who's operating what some people will call a lifestyle or sort of mom and pop business. All of the mechanism for raising that financing is still similar, and a lot of it is going to depend on what you've identified as your financial needs in your business plan in stage 2. Then, as you have put those items in place, you'll need to move forward with getting things in place to commence operations of your business. Sometimes that will entail licensing, sometimes that will entail permitting, hiring, of course, building out space, and then you get to stage 5, which is actually launching and opening and operating. I'll kick it back over to Adam. Before we dive into any of these in much greater detail, we'll go through the similar timeline process for conversion, and then we'll go from there.
Thanks, Helen. And I think we're probably going to focus a little more on financing startup co-ops, and Sarah's going to talk about her experiences with the startup co-op. But that's obviously not the only way that co-ops can be formed. And again, I'll sort of refer people. We did an entire webinar last year, an hour plus, I think, on the conversion process with CDI and some others. So there's some great resources available. But the co-op conversion process is similar in some ways to the startup process, but also very different, right? And that gets to really, for the conversion, you're taking an existing business, right, and you're converting it from maybe a corporation or an LLC into some form of cooperative, right? So you're not starting from scratch and going through all the stages. You actually have an existing business that's been in operation, which puts you in a different position in terms of the planning process as well as the financing needs. And what we see, particularly here in Maine and I'm sure elsewhere, we see a lot of the conversions as terms of a retirement plan or succession planning for existing businesses, right? So you may have a founder or founding family who have run a business for a generation, but they are looking to leave the business and try and figure out what is the future of the business, right? And one option in that situation is to effectively sell the business to sometimes the employees and convert to a worker-owned cooperative, in which case the workers will now take over the ownership of the business after the conversion and run the business moving forward. And I was sort of interesting to see, and this is more personal note, I saw in the paper last week that a local nursery near my house outside of Portland, Maine, had converted to a worker cooperative. So it was pretty cool to see just kind of a conversion story making the papers in the wild, which was very cool, with the support of Cooperative Development Institute, worked with them on that one. So again, the stages on the conversion process are going to be pretty similar in some ways to what Helen talked about. The first is the exploration process. Again, trying to figure out, is this the right option? What type of co-op? What does the process look like? And developing that plan, which again kind of then bleeds into stage 2, right? Which is going to be assessing the feasibility of the process. What is it going to look like? What steps are required to make the conversion? You then have into stage 3, which can take sort of, among the longest part of the process in planning the business and going out to secure the capital or the funds that you need to make the conversion effective, right? So if you think about a retiring business owner who is going to convert the business over to a worker-owned co-op, right? Those employees are going to have to raise the money to buy the company from the owner, right? And a lot of times, in most cases, the employees aren't going to have, the cash on hand to do that. They're going to go out and look for some form of financing, right? And Helen's going to talk about some of the options that you have. I think, commonly in the conversion process, you probably have a combination of a bank loan, right? So, typically secured by the assets of the company, and then you'd have some form of seller financing, right, where the former owner agrees to effectively lend money into the new co-op to be paid over some period of time, right? And that combination becomes the purchase price to fund the process at the time of executing the transaction, right, which is stage 4, right? That's when you actually complete the process, complete the loans, and close the deal, and the co-op acquires all of the assets. And then, the important thing, and this is where working with CDI and other experts in the process is really critical, is that this is a big change, right? For the co-op employees are now members. They're responsible for governance. It's a very different structure to the business, and so it's not simply close the deal and everyone goes on their way, right? There is a stage 5 of ongoing training, coaching, and support that's really critical to make sure that the co-op doesn't fail, right? And that it continues to succeed and carry on the business, to pay back the debt, pay the vendors, and continue the business into the future, right? And so, as you can see, it's not a quick process, and obviously the times can vary, and there's a lot of steps involved. But I would encourage anyone who's thinking about it to just reach out to whether it's CDI or Bernstein Shur or others that work on these types of things to help guide you through the process and the different steps. I think, is it back to you, Helen?
Yes, and I was just going to toggle back to the preceding slide to say we've got stage 5 here as opening. We really ought to have either a stage 6 or say opening semicolon ongoing training, coaching, and support, because the same thing would apply to a new business. And really that's going to drive the success of the company too, because to be able to have your members engaged in the governance process, you need to make sure that anyone new coming in is educated on what it means to be a cooperative and takes kind of responsibility and is involved in the ongoing governance of the entity on a move forward basis. So I won't scroll all the way back to our agenda to begin with, but if you remember, the next step was in our overall agenda was going into a little bit deeper dive on some of the core components of forming and financing and really getting your co-op up and running. And again, so we're doing a deeper dive on two primary areas, which is business plan. What does it mean to put together a business plan? What are some resources to help you with that? And then financial modeling. So a business plan is sort of very much what it sounds like. It is a plan for your business and how you're going to operate. My general advice, and not actual legal advice on here, but just general commentary, is when putting together a business plan, you shouldn't be trying to achieve sort of an A+ thesis paper. It is getting things in writing quickly so that you can map out and do a framework for how you think you want to bring your idea to market and move your business forward to succeed. And there's different components that go into that business plan. And there are many resources that can help you with putting that together. If you're putting together a business plan for a co-op, you kind of have two overlying things. So you can look at, and I had pulled up for the purpose of this presentation, a sample business plan template. Let's see if I'm sharing this appropriately. And this is from Score, which is is around the country. So this would apply whether you're in Portland, Oregon or Portland, Maine. This is just a general business plan template for a startup business. It is not tailored specifically to a cooperative. So that would be something that you'd want to consider. But taking a look at a template like this, whether it's from Score or another organization that helps with early stage companies and their overall business planning, I think is helpful, because you can look at different things that are prioritized to help you think about what you need to focus on and the pieces that you need to shore up before you really start diving into operations. So you know, thinking through your company description, as Sarah was mentioning a couple slides back, really thinking about what your values are as a group and the type of company and organization you want to be. That might flow into like, who are you going to be? What is your goal here? Building that into how you're describing the company and the purpose of your organization. Obviously, you're going to need to have a basic outline of what your products or goods or services are that you're going to be offering, and how you're going to offer those, as well as marketing and overall plan for that, operations, looking at your management and your organization. And again, with a co-op, again, I didn't pull up a sample co-op business plan template, but thinking through how you're going to be engaging all your stakeholders and your members as part of the governance process. This also includes several different, this particular template includes several different exhibits, like accounting for expenses and what initial capitalization are going to be, will be, putting together a financial plan, and other underlying exhibits that drive at you know, what do you need from a financial standpoint. So as you can see from this type of template, it's essentially a blank sheet with some prompts to get you thinking about it. There's other different forms of business plans, but again, the goal here is to help you get your ideas onto paper. Make sure that you and your co-founders are aligned on your path forward. And then you may or may not share that business plan with outside third parties. It may just be something that if you're putting together a package for a lender or for an investor, you fold that into a more comprehensive slide deck that feeds off of that business plan that you've put together. There are a few other sources that when you're working, or resources when you're working through your business plan, that might be helpful, and we've shared links here to some of those. Sarah's website has a great list that's specific to cooperatives. You can see a lot of these links here. And CDI, which is one of our sponsors of this, has a great startup 101 kind of pamphlet that you can access on their website in particular. Right, I will jump right on to financial modeling. So unless, Sarah, do you have anything to add on just that overview of a business plan?
The only thing I would say is that the template of a business plan is key, but what we found was that the executive summary and a slide deck is kind of what people really wanted in the beginning, because they're really just trying to be able to get their hands around who you are, or what your mission, vision, and your plan is. So, and often not the full-blown business plan is more helpful as you get farther along into operations. But you have to have elements and have thought through all of the structure that's in the business plan. So just sharing that.
Yes. Yeah. I think for many of you listening, you probably have experienced this in your own lives, which is saying something succinctly, like if you're trying to write a short message, can be much harder than having 3 paragraphs. So when you think about what Sarah was just saying, the executive summary and the slide deck being most helpful, at least in early conversations, in order to get there, you kind of need to have done the work that's the business plan. And that's what I'm saying, where you may not have third parties look at it, but you've got it. You may make adjustments to it as you go along, but it's just to help guide you as you launch and then operate your business. One other thing that I would note in terms of those early conversations and the score template that I just shared with you, it does have a confidentiality message on the score template, but I would say to the extent you're sharing slide decks or executive summaries with prospective lenders or prospective investors or partners, I always would encourage including a confidentiality legend at the bottom and making sure that to the extent you're sharing sensitive information, and this is particularly applicable once you get into financial modeling, that you do a confidentiality disclaimer, and you may want to use an NDA or something to protect your ideas. So with respect to financial modeling, there's a bunch of different components here. So ideally, once you've had your idea, you then go out and figure out what it's going to cost to produce your product, offer your service, what have you. And as part of that, you should really be looking towards preparing financial projections for what you think this is going to cost and how you think your business will perform over a couple year period. There are sometimes companies that will come to me with their financial projections going out for 10 years, and there's no way you can have any rational basis for anything like that. So this is something where like maybe you do financial projections for a year, 2 years, 3 years at the very most, but it's really to try to work through what you think your financial needs are going to be for a reasonable time period, because that's going to serve as some of the basis for helping you identify where your shortfalls are. It is, no business starts, at least none that I am aware of as having personally worked with, where they don't have to have an initial large capital infusion to be able to get going, whether that is self-funded from founders or whether they have to go out and take a bank loan or have independent investment. It is helpful to do this modeling so that you can understand what that need is going to be, and what types of returns you can offer to parties that are, whether it's an investor or a lender that's coming in. Can you service the interest rates that are being asked? Can you pay any sort of preferred return that investors are asking for? Preparing financial projections is usually not the strong suite of most founders that I work with. And so again, that's where reaching out to different resources for early stage businesses can be really helpful. Score, again, has some templates for early stage companies. And I've also found that if you don't already have an accountant to help you with some of your business finances, finding an accounting firm, particularly one that has done some work with earlier stage companies, oftentimes they have team members who can help companies with preparing some of the financial projections, not just doing taxes at the end of the year. Adam or Sarah, do you have anything else to offer on financial modeling? Or
I would just add, Helen, that to not be overwhelmed, and there's a lot of different shapes and forms this can take, and sometimes too, if you're starting to talk to a bank, and I know Chris Linder at CF&E talked about this last year, right? Talk to the bank or the parties. What are they looking for, right? Because I think, like you said at the beginning, Helen, don't get overwhelmed that you need this massive plan and all of these details, right? The exercise of putting it down on writing, at least to begin with, is really, really important, right? So you got to kind of fit what works best for your business and then the audience that you're working with as well, as you move forward.
all right. Okay, so then our other deep dive here in terms of overall financing. When you think about, so once you've done your business plan, once you have a sense of what your financial projections are going to be, then you have hopefully identified what capital you need to move forward with your business plan and on what time frame you're going to need that. So generally speaking, when you're starting a business, you want to hold off, at least initially, on bringing on outside investment capital, because early capital can be most expensive, because that's when some of the risk of the company is the highest. For some types of companies, the option of obtaining bank financing is challenging because there may or may not be collateral that can support a bank loan. I apologize, just was getting a call that I had to send to voicemail. So if you're trying to raise capital and you know that you're not going to be able to get a bank loan, your options would be really more in the world of private capital, where you're getting investment from outside investments, or you're getting grants. If you can receive grants early on, and no matter what stage of business you're in, that is great, and I encourage you to apply for those, or apply to business plan competitions where there may be some cash prizes. You would just want to make sure that you're doing an assessment of the time involved with those applications versus the financial reward that might be associated with it, to make sure that it makes sense for you and other demands that you may have in connection with starting your company. But if you're looking at the, beyond sort of the free money bucket, if you're looking at, am I getting a bank loan? Am I taking a loan from friends or family? Am I getting startup financing from private investors, angel investors, or a PE fund? That's where that latter piece there, sometimes the cost of that capital can be high, because we'll talk about this in just a second on the next slide with respect to valuation of the business. But because you're at a very early stage, the value of your business might be low, which means investors who would be taking equity would come in taking a fairly high percentage of the ownership, or would want to have preferences that would be dilutive to the other holders. It's interest that this is where some of the overlay with the cooperative comes in, because with patronage dividend requirements or other components like that, it's finding a balance of investment. But again, for startups, I would generally say take the time that you can to do what you can without obtaining outside financing. Shore up your business plan, get your financial projections to a place where you feel comfortable having them support your the business plan that you're going out with, and then start having those conversations with lenders or investors. It's a little bit different with operating businesses, because they may already have collateral, so it may automatically kick them into a realm where you could get an operating line of credit or something from a traditional bank lender. I realize now, in looking at this, that I should have reordered the slides, because jumping ahead to the timing, or I was talking about the timing of raising capital, but it's probably helpful to understand different types of funding. So we've already talked a little bit about bank debt, but that would be going to your traditional bank lender, which would really typically take they would want to make sure that their interest, or their investment, so to speak, by virtue of making a loan to your business, is secured by collateral. There's member sourced financing. So that's where you would go to your existing members that are part of your cooperative and obtain financing from them. This has some securities law implications, which I'm going to talk about very high level in just a second. Preferred share, which is investor financing. So that was what I was getting at in terms of the cost of capital. So when you have outside third party investors who come in most deals that I'm a part of, those preferred investors want what's called a preferred return. You can almost think of that like interest, and they want their capital back before there's any sort of distribution that would be made to the founders or other stakeholders of the corporation who came in before the investor class. Again, that's where there's a little bit of interesting interplay with the cooperative structure, but that's a very common type of financing structure. Crowdfunding, also listed here, has two components. There's what many people are familiar with, which is a rewards-based sort of crowdfunding, and that is where you're not actually offering equity in the company. You may be offering forms of your products or a t-shirt in support of your business or something like that. This is like a Kickstarter or GoFundMe. And then there's equity-based or securities-based crowdfunding, which is a different type of securities offering that you would do that enables you to raise funds from non-accredited investors, which jumps into bullet point number 3, legal considerations in raising new capital. So if you are raising capital from a private investor through the offer or sale of securities, so not like using the Kickstarter example, that is not giving someone a t-shirt in exchange for money that they've invested in your business is not the sale of a security. But if you're giving them a piece of ownership of your company in exchange for money that they are providing, that is the offer or sale of a security. And any offer or sale of a security in the US must be either registered or exempt from registration, or your offering is illegal. A registered offering, the easiest way to think of that in this very brief Securities Law 101 is like a public offering. That's not what we're doing here. You would really be looking at offering a piece of your business in compliance with a federal and state exemption from registration. And there's exemptions for private placements. Initial sales of interest in a co-op to its members are exempt securities. So it's just important anytime you're thinking about giving up ownership of your company and certain types of debt structures and offering those to private individuals, you should always think in the back of your head, do I have a securities law concern here? Am I, I should maybe talk to a lawyer to make sure that I'm complying with the applicable exemption. Differences between raising capital for cooperatives and other forms of new business entities. I'm looking at the time. I'm gonna just skip over that one for right now because we still have a couple more slides. And Sarah, I want to get to you before we have Q&A. Go ahead.
I would just say that for cooperatives, you're in a niche.
Yes.
And so there are debt companies like the Cooperative Fund of Northeast and others that are specifically geared towards supporting cooperatives. So it was easier for us to get debt through them than going to our bank, for example. And if you're in a niche within a niche, like we're about sustainable agriculture, there are also companies that loan around that as well. So really aligning yourself, your purpose, you'll find there are some non-traditional ways to support your cooperative.
Yeah, and I guess to not totally skip over this one, so that the last piece about non-traditional, I think that would be one of the differences is you just maybe have to spend a little bit more time finding who those non-traditional sources of capital are. So there's a big, any type of business, particularly if you're trying to get venture capital investment or PE investment, it's not like you're going to be sending out your slide deck to all of those capital providers. You're going to find the niche that, people whose investment thesis is investing in sustainable agriculture. Okay, they may be interested in my business plan. But you would have an overlay here of making sure that it's someone who at least has an interest in an understanding of cooperatives. Otherwise, you're going to find yourself, which is okay, but you just need to be aware that you're going to find yourself in a situation of needing to educate your prospective investor about what's a cooperative, how does this work, why can't the governance look like you would typically expect it to look in a VC-backed company or something like that. So let's jump to valuation very quickly, and then we'll get to Sarah's story. So this is just thinking about some of the hot topics. And whether it's a cooperative or not, valuation is always a hot topic because valuation gets at what is the business worth and what that means for the founders and the overall stake of the company that you're going to be giving to investors if you're offering equity as a mechanism for raising capital for your business. There is sometimes a tendency to try to set that valuation high because it's giving up the smallest stake that you can of the company, but there's risks in that if you end up not performing the way that you think you were going to perform to basically support that valuation. And Adam, I know you wanted to jump in and talk about some of those consequences, so maybe we can jump to that quickly. And
yeah, this is where sort of the cooperative work maybe meets my other work in, working with companies with financial distress, but maybe not so much an issue for startups and a lot of the funding that Helen's talking about, but certainly in the conversion process, right, where you're effectively buying the business from an existing owner and figuring out how you're going to finance that, and frequently that's done through new debt, right, in a couple different forms. And so and it's going to be based on evaluation that's going to be done usually by an independent third party professional, right, who's going to come in and appraise the value of the business. And so it's just really important to make sure that the valuation and the borrowing is the right size and is manageable for the company, right? And so it's not necessarily true that the higher value is better, right? Depending on sort of what side of the process you're on, because if you're the new owner employees, right, and you have to pay back that debt over a number of years, right, that can be a really significant financial burden, right? And so it kind of ties into, I think, everything that Helen's been talking about in terms of planning and the financial model, but the borrowing decision, I think, ties into that as well, and just making sure, is this something that you can service, right? Because particularly with a lender who's going to have a lien, a security interest in your assets, right? If you're unable to pay them, that can have very dire consequences for the business, all right? So just sort of, again, thinking about that and what the long-term effect of valuation is going to be, so that ultimately you can get to a level of paying back everyone that you need to be paying back and making those patronage dividends to the members, right? That's the ultimate goal of the co-op.
Yep. Yeah, and just to close the loop on valuation, and then I really want to kick it to Sarah. When you're thinking about what your business is valued, that's where some of these considerations for founders come in as well. So the founders have probably put blood, sweat, and tears into the company, maybe even before it started, before you've actually formed as a legal entity. And so it's this balance between what is appropriate to maintain for founder ownership versus what comes in as investors for new capital that's coming in, and that can be part of a negotiation. At the end of the day, the valuation is ultimately determined by oftentimes what a third party is willing to pay in the context of an investment. But it is, if you've done your financial modeling, if you've put together a very strong and cohesive business plan, then you should be able to get to a place where you feel very confident and comfortable in articulating what you think an appropriate valuation for your company would be. So now that we've walked through all of this rather rapidly, though not as rapidly as I hoped because I want more time for Sarah, we'll jump into Sarah's story, which is sort of a case study from inception to where she is now. So Sarah, I'll kick it over to you.
Yeah, thanks. So it's fun to take the whole template that Adam and Helen have outlined, because it is really almost exactly what we've done. So I can just maybe bring it to light with an actual with our company story. So we, like I said earlier, we're founded in 2019 as a worker-owned co-op, and by starting as a worker-owned co-op, we were able to. You have that choice. What kind of company do we want to be? So we were able to kind of use it as an opportunity to address inequity and try and create systems change around the imbalance of wealth and power. So that was really at the beginning for us. When I talk about our values, mission, and vision, that was the first thing that we did. And we're all about supporting local agriculture. We ferment our tempeh sustainably. We don't use plastic bags, which was an innovation that's proprietary that we're going to get a patent for. It took 3 years of R&D. That's why it took until 2022 to launch. Yeah, you can go to the next slide. Basically, our story is developing our mission, vision, and values, and working with an attorney. At the time, we turned right away to the Cooperative Development Institute to get the name of a lawyer. And that lawyer helped us create our bylaws articles and filed our papers for incorporation and got our tax ID and all those kinds of fun things. And we made sure that our values and mission vision were actually incorporated into our bylaws. They weren't, totally cookie cutter template. We really wanted them to reflect exactly who we are. And our early capital came from small founder investments, which we used towards both equity in the form of Class B preferred equity and member shares. So we did both at the same time. And I can't emphasize enough, use the resources around you. We were just wherever we could find support, we were going for it. So we were using Speare for help with the business plan. We used Maine Center for Entrepreneurs. We used the Maine Manufacturers Extension Partnership, which is great for manufacturing companies. And then the Small Business Development Center is another one. There's a lot of support out there for doing the executive summary and financial projections, which I mentioned earlier. We didn't do a full-blown business plan. We just did all the elements and outlines, mostly focused on creating a pitch, because we knew we were going to be, because of our financial modeling, we knew we were going to be raising money in addition to our own equity, because we needed to get equipment and space and all kinds of other things. So we did find a space right away at an incubator, Fork Food Lab. There are other types of incubators that are supportive, shared workspaces, all kinds of things like that in the beginning are really, really helpful. And then we also got a grant from the Maine Technology Institute for our innovation, our R&D innovation. So we were sort of off and running. And we then moved into, we were working, developing incubators, which take up a lot of space. And they didn't have enough wall space at Fork Food Lab. So we got a separate kitchen on our own for a while. And that's when we learned about some equipment that had become available. COVID had just started, and a tempeh maker in California lost 90% of their business was in institutional and food service, which of course shut down pretty quickly. So he offered his entire line to us, and we just couldn't say no, even though we didn't have a space for it. And so turned to Cooperative Fund of the Northeast, and because it really provided collateral. And we had, at that time, we had a strong story. We were building a good team. We had our financials nailed. We got the loan. So we were able to purchase the equipment, which was able to be put in storage for a little while we found a space big enough for all of the equipment, which included a 6,000-pound centrifuge. So we also at the same time participated in the Start.coop accelerator program, which I highly recommend. It's for scalable co-ops. Tons of resources came from that, including, further building out our business plan and our pitch. I'm trying to go a little faster here. The other support that was critical that we've received a lot of is having mentors. We had a mentor from Equal Exchange, really helped our structure for our equity. Then we found the space in Biddeford, 2,000 square foot production facility that we converted. We had to get all of our licensing together. And that's when we raised our first round of equity, Class B, which we're, like I mentioned, we're in a bunch of different niches. There were some that wanted to support co-ops that we were able to get institutional funding for, others that were slow money type people it's patient capital basically, and angel investors, as well as aligned institutions. So we raised over 300,000 in that round, and started hiring our production team, and then we launched in November. Right, let's see. And then the only other thing I'd add is we did do a second round, went back to a lot of the same funder, almost all of them came back in, and then we were able to get additional institutional investors, and that's really for the scaling of since the launch. And we had proved, following our plan, that we could come up with the innovation, we could actually launch, and then we had customers and distributors. So all of that came together. We then did Top Gun, which I highly recommend any of these programs where there is again mentorships and a chance to really fine-tune your plan and your marketing. There's many in Maine. I'm sure there are many around the country. And right now we're in another program called the Food Tech Program, which really helps bring efficiency to operations. And I just would say, get involved. We just joined the steering committee for the Maine Cooperative Business Alliance. They put on a great conference where you just, it's so important to get together with other cooperatives and share knowledge, resources, and networking. That's an opportunity that happens every April. And yeah, so I think that's pretty much our story.
Thanks, Sarah. That's great. And I would just, for people who are not in Maine on the call, some of the resources that Sarah referenced, like MTI, which is Maine Technology Institute, or Top Gun may have more of a national presence, but it's part of Maine Center for, there's a program that Maine Center for Entrepreneurs that it offers, this Top Gun program, which it helps you develop your pitch and your business plan and things like that. So I just want to say that. Go ahead.
They do exist all over the country. I've done them in other states as well. Yeah.
And that's what I was going to suggest, is if you're in a state other than Maine and you're thinking about start with your own backyard and see what programs are offered, because there really are, there's some organizations within a state that actually have a mandate to support certain types of companies or certain, and so see where there is alignment nearby and stakeholders who may be interested in what you're trying to achieve, because you can get some of that sort of grassroots support for you locally, and then as you start to grow and expand, and Adam will talk more about this next week, when you're looking to larger providers of capital more on a regional or national basis, you've got some strong supporters in your camp, and you've drawn on the resources that you can around. We have 2 minutes. I apologize.
Better than last week.
Yeah. And I'm not sure if everyone can see Q&A. If I'm pulling this up on the screen, is that visible? Or, okay, you're still seeing the slide. Okay. So there's a question: in a conversion from an LLC to a co-op, should the investment documents for securing first stage capital expressly state the intention to convert? And my answer to that is yes. So if as part of your business plan, your expectation is that you're going to be converting to a cooperative, but you are not already, you don't want to have in any of your disclosure materials to your investors, you need to make sure that you've disclosed all material information relating to their investment, and you haven't made any omissions of material fact. So if you're intending to do this conversion, if you're using dollars from the financing to convert to a co-op, and that's that's going to impact the business, that investors should very clearly have an understanding of that. So I think that one is complete. We received a note that sometimes a new business can start with and just do a business canvas model, which is like having a slide deck. Sarah mentioned Start.coop also shares that instead of a full written business plan. And that is very true. Start.coop has a great website. I'll just share that quickly with you all. They are very much focused on helping startup co-ops get the groundwork that they need to be able to operate, and they have great resources for that. And are we out of time now? It's noon, or there's one more here. So I can resolve this one. And then, does Maine co-op law have an exemption that allows for investments from non-qualified investors? So I think the question here is, the term under federal securities law is really an accredited investor or a non-accredited investor. An accredited investor under applicable securities law is, if you're talking about an individual, that's an individual who has a net worth in excess of $1 million, excluding their personal residence, or it is an individual who individually makes in excess of $200,000 a year in annual income, and has for the last 2 years, and has a reasonable expectation of making that, this year, or together with their spouse, that number is 300,000. So you could each, in theory, be making 150 or some other combination of that. And the rationale for that threshold and where that's relevant is most of the exemptions for securities offerings to private individuals are really set up. You can offer to non-accredited investors, but there's a lot more control around how that happens. So it's easiest and oftentimes in the best interest of the company to only offer to accredited investors. The reason there's that financial threshold there is the Securities and Exchange Commission has said that individuals who are at that sort of higher financial level have the ability to sustain some of the losses that could happen in early stage investment. So in any sort of early stage investment, you usually always, as part of your disclosure and your risk analysis, say that the investor can and might lose all of their investment, which is a scary thing for an investor that's putting money in. And that's part of the rationale for having some of these investor protections. There are some exemptions, like crowdfunding, that allow, and even a private placement exemption, provided that you're meeting certain information requirements, that allow for companies to raise money from what are non-accredited investors. But I think that's sort of beyond the scope of what we can cover at this point in this panel. So that maybe isn't the most direct answer, but it gives a little bit of information on that. Anything else? Or do we need to sign off?
I think we've run out of time. I think we did pretty well. We were very close. So thank you, Helen. Thank you, Sarah. See our contact information. Obviously, don't hesitate to reach out if there's questions or anything else we can provide. And I hope that everyone will join us same time next week for the third webinar. Thank you.
Bye, everyone. Thank you.
See you later. Thanks.